Warning! You're about to experience Metamodernism Uncensored, a podcast for diagnosing the cultural rot of the postmodern world and searching for real truth. It's time to question everything, especially yourself.
Welcome to Metamodernism Uncensored, the podcast diagnosing our postmodern world and attempting to push through to achieve metamodern synthesis.
And we are really glad you're joining us today because this one is heavy.
Yeah, it really is. I mean, our mission for today's deep dive is it's basically essential listening for anyone trying to navigate the sheer madness of our current economy.
Absolutely.
So we are immersing ourselves in two really provocative, fiercely debated articles. They were written in early 2026 by Sean Dempsey for the opposition.
Right.
The first one is called The Coming Crash is Unlike Any Other in USA History.
A very light and breezy title, you know.
Oh, yeah, totally uplifting. And then the companion piece is called How to Survive and Even Profit by the Coming Economic Collapse.
And I'll tell you, it is quite the roadmap he lays out for us. I mean, it's filled with these incredibly uncomfortable data points, stuff that just completely challenges almost everything we are told on the evening news.
It really does. Now, at first glance, if you just skim these pieces, Dempsey's writing might sound like, I don't know, just raw, unfiltered nihilism.
Right, it reads like a straight-up doomsday scenario.
Exactly. But if we actually do the work to achieve a metamodern synthesis today, we really have to look deeper.
We do, because he isn't just complaining for the sake of complaining.
No. He's suggesting that the postmodern rot, which is basically this raw hype of fantasy economics.
Yeah, the illusion.
This whole idea that lines on a graph can just magically go up forever.
Completely detached from any underlying real-world value.
Exactly. He's saying that this fantasy will inevitably collide with reality. So our goal for this deep dive is to figure out if his diagnosis of the financial system is accurate.
And we also need to see if his radical survival strategy offers a genuine path to metamodern resilience.
Or if it's just, the equivalent of an ostrich burying its head in the sand.
Right. That is the exact tension we need to explore today. And I just want to say to you, the listener, right up front, whether you are an investor desperately trying to protect your family's nest egg, or if you're just someone trying to understand why your grocery bill is suddenly astronomical while the news keeps saying the economy is booming.
Right. This deep dive is completely designed for you. We want to give you the clarity you need to navigate the coming storm.
Because knowledge is only valuable when it's understood and applied. And we are going to break down exactly what is happening under the hood of the global economy.
Okay, let's unpack this. Before we look at the specific bubbles that Dempsey says are about to burst, we need to understand the profound disconnect between the mainstream narrative and reality.
Yeah, the gap there is huge.
It's massive. And Dempsey points out something that I think you, listening right now, have probably felt in your gut. He critiques the mainstream media, places like CNBC, the major financial networks.
Right, because the official narrative being fed to us is that the post-COVID economy has just fully bounced back.
Exactly. They say the stock market is surging, and the Federal Reserve might even be lowering rates because things are just so bright.
The message is basically, everything is fine, your money is safe, just keep spending.
Yeah, and Dempsey uses this brilliant pop culture reference that just perfectly captures the mood on the ground.
Oh, the Zoolander quote.
Yes. He quotes Jacobo Mugatu from Zoolander, where he's screaming, "I feel like I'm taking crazy pills."
It's so accurate, though.
It is, because Dempsey looks at the data in plain sight, and it completely contradicts this rosy outlook. He feels like he's taking crazy pills because the reality on the street, the reality in your wallet, just does not match the ticker on the television screen.
What's fascinating here is the structural root of this illusion. To understand why we feel like we're taking crazy pills, we really have to look at what Dempsey calls the fiat illusion.
Right.
He takes us back to a crucial pivot point in history. 1971.
The Nixon shock.
Exactly. In 1971, President Nixon completely took the United States off the gold standard.
Right, so prior to that, the paper dollars in your wallet were, well, at least in theory, backed by a physical equivalent of gold held in government reserves.
Right. It meant there was a physical constraint.
So before 1971, if the government wanted to print more money, they fundamentally had to acquire more gold to back it up, right?
Precisely. It imposed strict discipline on the system. But after 1971, we moved entirely to fiat money.
Meaning it's just backed by nothing but a promise.
It's just the full faith and credit of the U.S. government. There is literally no physical asset tying the currency to reality anymore.
Wow.
And the consequence of removing that constraint is that the Treasury and the Fed have been able to print money with reckless abandon. And it's accelerated wildly over the last 2 decades.
Yeah, Dempsey highlights a staggering statistic in the text that really puts the scale of this into perspective.
Oh, the physical versus digital numbers.
Yeah. Today, there are only about 2.26 trillion physical dollars in circulation globally.
Right.
That is actual printed, tangible paper money and coins.
Yeah.
But on bank ledgers, like in the digital ether, there are roughly $83 trillion.
Yeah.
Wait, let me just pause on that for a second because that is mind-boggling to me.
Yeah.
2.26 trillion in actual physical reality and 83 trillion in digital reality.
It's hard to even wrap your head around.
I mean, how does that even happen? How do we get $80 trillion of phantom money just floating around?
Well, it happens through the mechanics of central banking and digital ledger creation. When the Federal Reserve buys assets or when commercial banks issue loans, they aren't handing over suitcases of physical cash.
Right.
They are literally just typing numbers into a computer. They are creating digital liabilities out of thin air.
That's terrifying.
Yeah, and if we connect this to the bigger picture, it means the vast majority of our global wealth is essentially a shared hallucination.
A hallucination.
Exactly. It only exists because we all collectively agree to believe that those keystrokes on a central bank computer actually have purchasing power.
So what does this all mean for the average person? Because that hallucination has a direct, painful cost to you, the consumer.
Oh, absolutely.
And it manifests as inflation.
It's just a simple issue of supply and demand, really. If you increase the supply of the currency, exponentially pumping tens of trillions of digital dollars into the system,
Right.
but you do it without a corresponding massive increase in the actual goods and services produced by the economy.
Then the purchasing power of every individual dollar just plummets.
Exactly. More dollars chasing the exact same amount of goods means prices go up.
And this is where that crazy pills feeling really hits home. The government and the media will advertise an inflation rate of, say, 4 to 5%.
Right, they tell you it's moderating, it's totally under control.
But Dempsey isn't buying it. And I doubt you are either if you've been to a grocery store lately. He cites data from Shadow Stats and references the 1995 Boskin Commission to argue that the way inflation is calculated has been heavily manipulated.
This raises an important question, right? How do they manipulate the math?
Yeah, how do they get away with it?
Well, the Boskin Commission effectively allowed the government to change the actual formula for the Consumer Price Index, or CPI.
Right.
They introduced concepts like substitution and hedonic quality adjustments.
Meaning what exactly?
So if the price of steak goes up too much, the formula just assumes you'll start buying cheaper hamburger meat instead.
Oh, wow.
Yeah, so they swap it out in the theoretical basket of goods, which artificially lowers the reported inflation rate.
That's insane. It's like changing the rules of the game while you're losing.
Pretty much.
Dempsey argues that if we measured inflation today the exact same way we did back in the 1980s, before all these statistical tricks, the real rate of inflation is likely in the 13 to 15% range every single year.
Yeah, and the underlying math on the street simply doesn't support the 4% narrative anyway. You just have to look at the cost of living over a very short period.
Right. Dempsey lays out the numbers super clearly. From 2019 to 2023, home prices nationwide went up a staggering 54%.
54% in 4 years.
Rent surged 30.4%. Food and groceries increased by 25%. I mean, think about your own paycheck. If your wages didn't increase by 30 to 50% in that 4-year window, you became poorer.
You lost massive amounts of purchasing power.
But if savings accounts are a guaranteed loss against 15% real inflation, what is the average person supposed to do? You can't just stop trying to build wealth.
No, you can't.
In the past, you could put your money in a safe harbor like a high-yield savings account or CD and actually beat inflation. Your money would grow safely.
But that was before the Federal Reserve kept interest rates artificially suppressed near zero for over a decade following the 2008 crash.
Right.
So if you're getting 3 or 4% in a safe account, but inflation is eating 15% of your purchasing power, you are bleeding wealth every single day.
It's a trap.
It is. The system forces a behavioral shift. You are forced out onto the risk curve. You become a gambler, even if you don't want to be. To just keep up with the real rate of inflation, the average person, the retiree, the young family saving for a house, they are forced to take their hard-earned money and put it into the much riskier stock market.
Right. They are forced to participate in the asset bubble just to tread water. It's not human greed driving this massive stock market surge. It is mechanical necessity engineered by central bank policy.
Exactly.
Which brings us perfectly to the core of Dempsey's warning. If the foundation of our entire economy is built on these digital IOUs, and hidden, rampant inflation is forcing everyone to over-leverage themselves in risk assets, what actually causes this massive house of cards to collapse?
And he has a very specific answer for that.
He does. Dempsey doesn't just wave his hands vaguely at the economy. He points a very specific finger at the first major domino that is going to fall. And he says it's the corporate real estate, or CRE loan bubble.
And the timing on this is terrifyingly specific. He points to the year 2026 as the reckoning.
So, right now.
Right now. The data is stark. In early 2026, $570 billion in commercial real estate loans reach maturity.
$500 billion.
And that's followed by another $460 billion later in the year. In total, a staggering $2.0 trillion in CRE mortgages are coming due.
That's T with a trillion.
Yes. And right now, 40% of the commercial real estate assets currently in duress are corporate offices.
Okay, to really understand why this is a ticking time bomb, we need to look at how these buildings are actually bought and paid for. Because it's not like buying a regular house.
No, not at all.
If you buy a house, you generally get a 30-year fixed-rate mortgage. You pay a little bit of interest and a little bit of principal every month. And eventually, over 3 decades, you own the house outright.
Right, that's standard.
But that is not how a skyscraper in Manhattan or a massive suburban office park in Chicago is financed.
No. Institutional investors do not buy a $20 million office building with a briefcase full of cash. They use leverage.
Right.
And the anatomy of these commercial loans is fascinating, but deeply flawed in our current macroeconomic environment. These are typically 5 to 7 year adjustable rate mortgages or ARM.
Yeah.
And crucially, they are often interest-only loans.
Okay, let's do the math on this for the listener, because when I read the mechanics of this in Dempsey's article, my jaw literally hit the floor.
It's wild.
Let's say an investor wants to buy a $20 million commercial property. To get this interest-only loan, the bank requires them to put up 50% equity. So the investor puts down $10 million in cash.
Right.
The bank finances the remaining $10 million. Historically, over the last decade of zero interest rate policy, they were getting these loans at an incredibly low rate, say 3.25% interest.
And because it's an interest-only loan, their monthly payment is purely covering the 3.25% interest on that $10 million.
Just the interest.
Just the interest. They're paying absolutely $0 toward the principal. The original $10 million debt just sits there untouched for 5 to 7 years.
So their monthly payment is around $27,000.
Yeah.
And they can write that off as a business tax deduction.
Yep.
Now, in the fantasy postmodern economy where lines only go up, here is what happens next. Over those 5 years, the building appreciates in value. Let's say it goes from $20 million to $23.2 million.
Okay.
The investor has paid about $1.6 million in interest over those 5 years. But the building's overall value went up by $3.2 million.
Right.
Because they only invested $10 million of their own cash, their return on investment is massive. When the 5-year term is up, they take out a new loan against the newly appraised $23.2 million value to pay off the old $10 million balloon payment, and they walk away incredibly wealthy.
That is the magic of leverage.
Right.
It works beautifully as long as the underlying asset continually appreciates. But if we connect this to the bigger picture of the post-COVID world, that fundamental assumption has been completely shattered.
So what does this all mean for today? Because I thought of an analogy for this.
Okay, let's hear it.
It's like leasing a brand new luxury car. You lease it because you fully expect it to appreciate into a highly sought-after, rare collectible. You plan to sell it at the end of the lease, pay off the dealer, and pocket a huge profit.
Makes sense on paper.
Right. But instead, over those 5 years, the car model gets recalled, the paint peels off, the engine blows, and it turns into an absolute rust bucket that nobody wants to drive.
Yeah.
And you still owe the dealer the original sticker price.
That is exactly what has happened to corporate office space. The post-COVID remote work revolution just emptied out these buildings.
Everyone went to Zoom.
Exactly.
Yeah.
Companies realized they didn't need massive downtown footprints. We are seeing major office buildings in metropolitan areas with 50% vacancy rates.
Half empty.
Half empty. Consequently, the revenue these buildings generate has plummeted, and therefore the buildings themselves are now only worth 40 to 80% of their original purchase value.
And remember, that 5 to 7 year timer is up in 2026. The balloon payment is due. That original $10 million principal still has to be paid back to the bank in full.
Now, in a normal environment, the investor would just refinance the loan.
Right. Just roll it over.
But you cannot refinance a building that is severely underwater. If the building was purchased for $20 million and the investor owes the bank $10 million, but because of vacancies, the building is now only appraised at $8 million.
Wow.
No bank on earth is going to give them a $10 million loan to cover the old one. The collateral simply isn't there anymore.
It's gone.
It's gone. Furthermore, the cost of borrowing has changed drastically. The Federal Reserve raised rates aggressively to fight the inflation we talked about earlier.
Right.
So commercial mortgage rates are no longer 3.25%. They are sitting at 7 to 10%.
So if they somehow could miraculously refinance, their monthly payments would triple or quadruple.
Exactly.
The rental income from a half-empty building can't even cover the basic operating costs and property taxes, let alone a 10% interest rate on a massive underwater loan.
Yeah.
So the owners are totally trapped.
They are completely cornered. And Dempsey provides chilling, real-world examples cited from the Washington Post to prove this isn't just theoretical modeling.
Right, it's happening right now.
It is. He notes a specific building in Washington, D.C. that was purchased for $100 million in 2018. It just sold in December for $36 million.
Are you kidding me?
That is a $64 million loss, a complete wipeout of the equity.
He gave another one in the article, too. A renovated high-rise bought for $62 million in 2017. Sold in January for $18.2 million.
An absolute bloodbath.
A loss of nearly $44 million. The owners are basically taking whatever pennies they can get just to escape bankruptcy.
Or they are simply defaulting. They're just handing the keys back to the bank and walking away.
And this brings us to the contagion effect, which is the truly systemic threat here. Because this isn't just bad news for wealthy commercial real estate developers.
No, it's much bigger than that.
When these owners walk away, the banks, specifically the regional banks that hold the vast majority of these CRE loans, are left holding the bag.
Right. The bank lent out $10 million against an asset that is now only worth $8 million.
So they're taking the hit.
They have to foreclose, attempt to sell it in a dead market at a massive loss, and write down that loss on their balance sheets.
And when you have $2 trillion of these loans coming due in a highly condensed time frame, you get a commercial bankruptcy wave that acts as a violent catalyst.
Yes, it threatens the solvency of the entire regional banking sector.
And if the regional banks are already bleeding out from empty office buildings, they have absolutely no margin for error. But Dempsey points out they are simultaneously getting squeezed from a completely different direction.
They are.
Because a banking crisis triggered by commercial real estate doesn't happen in a vacuum. It threatens to violently pop several other historical bubbles simultaneously. So let's look at the contagion moving into the stock and bond markets.
Right. Let's start with the bond bubble, because this directly impacts those exact same struggling banks. For the listener who might not trade fixed income assets, the key mechanic to understand is the inverse relationship between bond prices and bond yields.
Okay, break that down.
Think of it like a seesaw. If the Federal Reserve sits heavily on the interest rate side and pushes yields up, the price side of existing bonds gets violently forced down.
So for over a decade, the Fed's policies pushed U.S. Treasury yields artificially low, meaning the prices of those bonds were artificially high.
Exactly.
And banks bought trillions of dollars of these safe government bonds at, say, 1 or 2% yields.
But as the Fed has been forced to rapidly raise interest rates to fight inflation, that artificial downward pressure on yields has been removed. New bonds are now paying 4 or 5%.
Right.
So who wants to buy a bank's old bond paying 1%? Nobody, unless the bank sells it at a massive discount.
So the value of the existing bonds sitting on the bank's balance sheets just plummets.
Correct. Banks and institutions are holding massive portfolios of these older, low-yield bonds and suddenly find themselves sitting on massive unrealized losses.
Unrealized meaning they haven't sold them yet.
Right. As long as they hold the bonds to maturity, it's just an accounting issue on paper. And here's a contagion. if the liquidity crisis hits because of a wave of commercial real estate defaults, and these banks are suddenly desperate for cash, they are forced to sell those bonds on the open market.
Oh, man.
When they sell, those unrealized losses become very real, very fast. It evaporates their capital reserves, and this is exactly the dynamic that took down Silicon Valley Bank.
Okay, so the banks are getting squeezed from both sides. Commercial real estate is collapsing on the left, and their bond portfolios are bleeding out on the right.
And meanwhile, the stock market bubble is perched precariously on top of all of this.
Yeah, Dempsey argues the stock market surge is driven entirely by the Fed. By eliminating those safe harbors for over a decade, they forced all the capital in the world into equities. People weren't buying stocks because the companies were intrinsically more valuable or, innovating at unprecedented rates. They were buying them because there was literally nowhere else to park the money to escape the 15% hidden inflation.
It's the TNA effect, right? There is no alternative.
Yeah.
But Dempsey highlights a third contagion factor that I found absolutely terrifying, and it's something you rarely hear discussed with any depth on the evening news. He calls it the yen carry trade bubble.
I am so glad we're diving into this because this feels like the invisible boogeyman of global finance.
It really is.
Let's break down the mechanics of this for the listener. Basically, global investors, massive hedge funds, and institutional banks look around the world for cheap money to borrow.
Right.
Historically, the Central Bank of Japan has kept their domestic interest rates incredibly low, effectively zero or even negative for a very long time, just trying to stimulate their own sluggish economy.
So these massive institutional investors borrow billions and billions of Japanese yen. They are essentially getting free money.
But you don't just sit on free money in a Japanese bank account.
No, you take that borrowed yen, convert it, and you invest it into higher-yielding global assets. You buy U.S. tech stocks, you buy high-yield corporate bonds, you buy commodities, or even real estate.
And this strategy works brilliantly as long as two specific conditions hold true. The Japanese interest rate stays near zero, and the U.S. assets you bought continue to yield high returns.
Exactly.
You are purely profiting off the spread, the differential between your cheap borrowing costs and your high investment return. Recently, Dempsey notes that because U.S. rates have gone up while Japan stayed low, the yen has been trading at about a 30% differential.
Hedge funds are making a killing on this.
But, and here is the massive thread hanging like the sword of Damocles over the global market. What happens if Japan finally has to deal with its own domestic inflation?
Right.
What if the Central Bank of Japan decides they can no longer maintain a zero interest rate policy and they have to raise their rates?
That is the trigger for the mother of all margin calls. If the borrowing cost in Japan suddenly rises, the profit margins on this massive, multi-trillion-dollar global carry trade shrink rapidly or disappear entirely.
Spread vanishes.
Exactly. Suddenly, the debt becomes wildly expensive to service.
So these institutional investors are suddenly holding leveraged trades that are bleeding money by the second. They're forced to liquidate.
They have to sell everything.
Wow.
Yes. They have to immediately sell all those U.S. tech stocks, all those global bonds, all those commodities to raise the cash to pay back the yen they borrowed before the rising interest rates absolutely crush them.
Which triggers a massive synchronized liquidation across various global asset classes.
It's a forced selling event on a scale that is hard to comprehend. It crashes markets indiscriminately because they aren't selling based on the fundamental value of the stocks they're selling because they desperately need liquidity.
And Dempsey firmly disagrees with mainstream analysts who downplay this risk. He specifically calls out an analyst named Anindya Banerjee. Banerjee claimed that because Japan's monetary policy divergence is so stark, we won't necessarily see a catastrophic price movement. He argued that the infamous 2007-2008 carry trade unwind was only severe because it happened concurrently with the broader global financial crisis.
What's fascinating here is Dempsey's counter-argument to that. Banerjee says, don't worry, 2008 was a unique global crisis.
Right.
But Dempsey is looking around at the commercial real estate collapse, the unrealized bond losses, the inflated stock bubble, and saying, we are in a broader global financial crisis right now.
It's already happening.
Exactly. It's just that the mainstream media hasn't admitted it yet. He believes this unwind, combined with the CRE collapse, will make 2008 look like a walk in the park.
Dempsey brings up a great historical analogy here to put this into perspective. He mentions the famous Dutch tulip bubble of the 1630s.
Oh yeah, the tulips.
For anyone who doesn't know, this was a period in the Netherlands where the price of tulip bulbs skyrocketed to insane levels. People were paying the equivalent of $1,500 or a whole year's salary for a single flower bulb.
Just unbelievable.
It was driven purely by speculative mania. Eventually, the fever broke, reality set in, and the price crashed to zero, ruining countless people overnight.
But this raises an important question, and it's a point where we should push back slightly on Dempsey's framing, or at least refine the mechanics of his comparison.
Okay, how so?
The tulip bubble was driven by raw human psychology mania, greed, the fear of missing out. The bubbles we are looking at today, particularly the stock and bond bubbles, are not primarily driven by human mania.
Right. I'm not buying an S&P 500 index fund because I'm irrationally, feverishly obsessed with tech stocks the way the Dutch were obsessed with tulips.
No, you're not.
I'm buying it because my savings account is yielding 4%, while real inflation is at 15%.
Exactly. It's a mechanical inevitability engineered by central bank policies. People are buying overpriced stocks not because of mania, but out of absolute desperation to escape the hidden inflation that is eroding their fiat currency.
That makes total sense.
So the systemic risk today is actually much more dangerous than a tulip mania, because you can't cure it by just waiting for people to sober up and come to their senses. The mechanics of the system itself are structurally broken.
Which means the damage won't just be confined to Wall Street. It's not just the institutional investors or the hedge funds playing with yen or the corporate high rollers with their empty office buildings who are at risk.
Yeah, everyone.
A systemic rot has infected the foundation of the everyday consumer. You, the listener, are trapped in this web of debt, relying on safeguards that Dempsey argues might just be complete illusions.
Let's examine the consumer-level bubbles Dempsey outlines, because the numbers here are truly staggering, and they highlight how fragile the average household balance sheet really is right now.
Okay, let's start with the college education bubble. We're looking at $1.77 trillion in student loan debt in the United States.
$1.77 trillion.
Yeah. The average college graduate is walking across the stage to get their diploma with $37,172 in non-dischargeable debt strapped to their back.
And Dempsey is brutal in his assessment here. He argues that the federal government getting involved in student loans artificially skewed the demand curve.
How so?
Well, free guaranteed money from the government meant colleges could jack up tuition to the stratosphere without any market consequences.
Right, because the check was guaranteed to clear.
Exactly. And the return on investment for the student has plummeted concurrently. Dempsey cites claims that non-STEM degrees outside of science, technology, engineering, and math, are now being called the biggest scam in history.
Wow.
You have an entire generation, millennials and Gen Z, burdened with massive debt for degrees that do not guarantee a job that pays a living wage, especially not in a high-inflation environment.
They end up moving back home, unable to buy houses, unable to participate in the broader economy. And it doesn't stop there. Because their wages aren't keeping up with that 15% real inflation, they turn to plastic to survive.
The credit cards.
Yeah. Let's look at the consumer debt bubble. $17.3 trillion in total consumer debt. The average American is holding $23,317 in credit card debt alone.
And that number is growing at 8% a year.
If we connect this to the bigger picture, this consumer debt was only somewhat manageable when the Fed kept interest rates near zero.
Right. But as credit card interest rates soar past 20, sometimes 25%, the math becomes suffocating.
It's impossible.
That $23,000 balance becomes an inescapable black hole. The consumer is completely tapped out. They are spending their disposable income just servicing the interest on their debt, leaving absolutely nothing for actual economic growth.
And what happens when that tapped-out consumer looks to the future? What about the safety nets they've paid into their whole lives?
Oh, this is grim.
Dempsey takes a sledgehammer to Social Security. He literally calls it a flat-out Ponzi scheme.
And honestly, the mathematics of Social Security are incredibly bleak. It is projected to be structurally insolvent by 2035.
2035, that is right around the corner.
It is. The demographic ratio of workers paying into the system versus retirees drawing from it has inverted. You simply don't have enough young workers supporting the massive wave of retiring baby boomers.
What's the fix?
Well, Dempsey points out the absurdity of the political solutions often floated. To just grow our way out of this mess through taxation and economic expansion, the United States would require mathematically impossible double-digit GDP growth year over year for 75 consecutive years.
It's a statistical impossibility. The math just doesn't work.
No, it doesn't.
And above all of this, hanging over every single citizen, is the U.S. national debt. $39.29 trillion.
$39 trillion.
Dempsey paints this vivid, terrifying picture of the citizens of Pompeii happily conducting business in the streets, totally oblivious just hours before the volcano erupts.
It's a good analogy.
The interest payments alone on a $39 trillion debt, especially in a high-interest rate environment, will eventually consume the entire federal budget. It'll inevitably crush whatever value is left in the fiat dollar as they are forced to print more just to pay the interest.
But perhaps the most shocking revelation for many listeners will be Dempsey's breakdown of the banking system itself.
Yeah, this part got me.
We touched on the fragility of banks earlier with the commercial real estate contagion and the bond losses, but let's look at the daily mechanics of how your local bank actually operates. Fractional reserve banking.
This is one of those things that once you learn how it works, you never look at a bank teller the same way again.
Never.
I mean, we grew up thinking a bank is a vault. You put your money in, it sits there safely, and the bank pays you a little interest for the privilege of holding it.
That is the illusion. When you deposit $1,000 into your local bank, the bank does not put that $1,000 into a vault with your name on it.
Right.
By law, under fractional reserve banking, they are only required to keep a tiny fraction of that money in reserve. Historically, as little as 3 to 10%. And actually, during COVID, the reserve requirement was dropped to 0 for a time.
0. Wow. Let's explain how this multiplies because it's wild.
Yeah, walk us through it.
You deposit $1,000. The bank keeps, say, $100 in reserve and lends out $900 to a guy buying a used car.
Okay.
The car dealer takes that $900 and deposits it into his bank. His bank keeps $90 in reserve and lends out $810 to someone remodeling their kitchen. The contractor deposits the $810 and so on.
It's just cascades.
Through this multiplier effect, your initial $1,000 physical deposit can mathematically create up to $100,000 in new digital money sloshing around the financial system.
It is the ultimate creation of money out of thin air. And it works perfectly fine until confidence breaks.
Right.
It works until everyone wants their physical money back at the exact same time. That is a bank run.
And this is where everyone listening usually takes a deep breath and says, well, I'm not worried my money is FDIC insured.
Right. Of course, that's what everyone thinks.
The Federal Deposit Insurance Corporation, the gold sticker on the bank window,
Right.
the guarantee that up to $250,000 of your money is safe no matter what. But Dempsey runs the math on the FDIC, and this is the ultimate shock factor. The FDIC, our supposed ironclad safety net, only has about $125.3 billion in its reserve fund.
Which sounds like a lot of money to an individual until you realize the macroeconomic scale of the deposits they're supposedly insuring.
Exactly. That $125.3 billion covers exactly 0.25% of all U.S. deposits.
Oh my gosh.
0.25%. If a systemic banking failure happens, triggered by that $2 trillion commercial real estate collapse causing regional banks to fold simultaneously, the FDIC is mathematically useless.
Completely useless.
It's like an insurance company holding a bucket of water and promising to put out a forest fire.
And this raises perhaps the most chilling point in Dempsey's entire analysis. What happens when the FDIC runs out of money? What happens when the banks fail and the insurance is tapped out?
Yeah, what's the backup plan?
He points to the Dodd-Frank Act, sweeping financial legislation passed after the 2008 crisis. In 2008, we had bailouts. Taxpayer money was printed to save the banks.
And everyone is furious.
Right. The public was outraged that Main Street bailed out Wall Street. So politicians passed Dodd-Frank and promised no more tax-force bailouts.
But they replaced it with something far worse, a bail-in.
Precisely. Under current law, thanks to Dodd-Frank, when you deposit your money into a bank, you are legally classified as an unsecured creditor of that bank.
An unsecured creditor.
Yes. The money is no longer legally your property. It is a loan you have made to the bank.
Wait, let's make sure the listener really hears this. If I put my paycheck in the bank, legally it's not my money anymore.
Correct. You have exchanged your money for a claim against the bank. If the bank fails and the FDIC is tapped out, the bank can legally seize your deposits.
They can just take it.
They convert them into equity in the failing bank and use your cash to pay off its massive debts and recapitalize itself.
That is insane.
And this isn't a conspiracy theory. Dempsey points out this is exactly what happened in the nation of Cyprus during their banking crisis.
Oh.
Citizens woke up on a Monday morning to find their savings accounts had been slashed by the banks legally to save the banks.
It is the ultimate systemic rot. The institutions designed to protect the consumer are legally positioned to cannibalize them in a crisis.
It's a sobering reality.
Okay, we have outlined a terrifying, precarious deck of cards. From the macro fiat illusion to the commercial real estate time bomb, through the contagion of the yen carry trade, all the way down to the legal vulnerability of your personal checking account.
It's a lot.
So the obvious question is, who is lighting the match? Who is responsible for building this system? Now we have to talk about politics. And I want to be super clear to you listening right now, we are not taking sides here.
No, absolutely not. We are merely conveying Dempsey's argument.
Exactly. Before we dive into Dempsey's political analysis, we need to frame how he approaches this, because his political analysis is going to make people on both sides of the aisle highly uncomfortable.
Right, because he argues this isn't a simple red or blue issue. He is diagnosing a systemic, bipartisan failure that has spanned decades.
He argues that this economic powder keg is a shared creation, but he specifically highlights what he calls the Trump wildcard in recent history.
Let's get into that.
Dempsey points out a massive contradiction between political rhetoric and economic reality. Despite campaigning and presenting himself as a fiscal conservative, Donald Trump's actual spending record was historically unbalanced.
Right.
Between his budget proposals, like the BBB, and a massive $1.5 trillion military budget, Dempsey notes that Trump spent more federal money than Presidents Obama and Bush combined.
And Dempsey is equally critical of the current administration, noting that President Biden came into office and amplified this reckless spending even further with massive domestic spending packages.
Yeah, he uses a really vivid analogy for the deficit reduction that the current administration often touts post-COVID.
No, the donut analogy.
Yeah, he says it's like an obese man who goes from eating 50 boxes of donuts a week down to 25 boxes of donuts a week.
Right. The rate of gluttony may have decreased slightly from the peak pandemic emergency levels, but the man is still getting fatter every single day.
Exactly. The underlying systemic issue of vast deficit overspending hasn't been fixed at all. It's just slowed its acceleration slightly.
Then you add in the geopolitical spending, which Dempsey argues acts as fuel on the inflationary fire. He is highly critical of the endless proxy wars.
He points out the $175 billion sent to Ukraine.
And he makes a crucial economic point here. That wasn't surplus tax revenue being spent.
No, because we are running a massive deficit.
So that was $175 billion of newly printed fiat currency injected into the global system, further diluting the dollar and driving the inflation that is crushing the American consumer.
On top of that, you have ongoing trade wars, tariffs, and sanctions involving Russia, Venezuela, Iran, and China,
which disrupt global supply chains, make manufacturing more expensive, and drive consumer prices even higher at the checkout counter.
What's fascinating here is Dempsey's critique of how the political right often approaches this problem. He attacks the false security of tax cuts when they are implemented without corresponding massive spending cuts.
Right. If you cut taxes, which lowers government revenue, but you simultaneously increase spending on the military or domestic programs, where does the difference come from? The printing press. Exactly. Or issuing more debt that the Fed eventually monetizes. Both sides of the political aisle, according to Dempsey, are fundamentally addicted to the printing press.
They just use the newly printed money to fund different ideological pet projects.
Yep. True fiscal conservatism, he argues, requires an absolute painful reduction in government size, bureaucracy, and spending.
In fact, Dempsey points to a very specific contemporary figure as the only viable model for the radical structural overhaul needed.
Javier Milei.
Yes, Javier Milei, the libertarian president of Argentina, who has aggressively and controversially slashed government ministries and spending to combat his nation's hyperinflation.
So we have a diagnosis of absolute pervasive bipartisan rot. The postmodern fantasy of consequence-free deficit spending and zero interest rate policy is about to hit the brick wall of reality.
Knowing all of this, how do we push through to a metamodern synthesis?
Right. What's the plan?
Dempsey isn't just sitting in a bunker complaining. His companion article offers a very specific blueprint for survival and profit. The question is, are these solutions brilliant, or are they dangerously naive?
Let's examine his survival framework. Dempsey outlines a defensive posture followed by an offensive posture.
Okay, let's start with defense.
He advises moving savings out of risky regional banks because of the CRE exposure and bail-in risks we discussed, and into less risky institutions. Specifically, he highly recommends whole life insurance policies managed by large, legacy mutual companies.
Wait, let me push back on this on behalf of the listener. Why an insurance company? How does an insurance policy protect my cash better than a bank vault?
It's a fair question.
That sounds like just buying a death benefit, not protecting my liquid saving.
It comes down to the corporate structure and regulatory environment. A mutual insurance company is not publicly traded. It is owned by its policyholders.
Okay.
And crucially, they do not operate on fractional reserve banking. If you put cash into a high cash value whole life policy, that cash value is backed by the general portfolio of the insurance company, which is heavily regulated and historically far more conservative than a regional bank's loan book.
So it's not leveraged to the moon.
Exactly. And you can borrow against that cash value at any time. Dempsey is arguing that in a systemic banking collapse, a 150-year-old mutual life insurance company is structurally far more insulated from a bank run than a fractional reserve bank holding underwater commercial real estate loans.
Okay, that makes sense structurally. So that's one defensive move. The next defensive move he suggests is allocating 10 to 20% of your wealth into physical gold and silver.
Right.
And he is very clear here on the psychology. Do not view this as an investment that will make you rich. View it as a safe haven wealth preserver.
Yes. This ties directly back to his critique of fiat currency. When the fiat dollar collapses due to rampant inflation, physical precious metals in your own physical possession will retain their purchasing power.
A gold coin is nobody else's liability.
Exactly. It cannot be printed into oblivion, and it cannot be seized in a bank bail-in if it's buried in your backyard or held in a private vault.
So if whole life insurance and gold are defense, does Dempsey offer any way to play offense while the market is crashing?
He does, but it gets highly aggressive. He suggests a speculative allocation strictly limited to 1 to 5% of your portfolio to short the market.
For the listener, shorting means betting that the price of an asset will go down rather than up.
Exactly. But he doesn't recommend complex options trading for the average person. He suggests using low-risk inverse ETFs or exchange-traded funds.
What do those do?
These are funds designed to perform the exact opposite of whatever index they track. He lists tickers like Schiff to short the financial sector, UDN to short the US dollar, DRV to bet against housing, PSQ to bet against the NASDAQ U tech stocks, and VXY to bet on increased market volatility.
And he mentioned leverage ones too, right?
He did. He even admits to personally holding riskier leveraged inverse ETFs like SKQQQ or SRTY, which multiply the downward movement. But he strongly cautions that this is gambling, not investing.
Yeah, that's meant only for those with a strong stomach who want to profit actively on the way down.
Then we hit the most radical move in his playbook, the real gamble.
Okay.
He advises liquidating 60 to 80% of your entire stock market portfolio into pure cash. Just pull it out of the market entirely.
Which sets up his final offensive maneuver. You sit on that massive pile of cash, you wait patiently for the banking crash and the CRE collapse to hit.
Right.
And then, within a narrow 6 to 12-month window, while everyone else is panicking and forced to liquidate like those hedge funds caught in the carry trade, you pounce.
You buy the dip.
You use that cash to buy up high-quality assets. Arable land, single-family homes, blue-chip dividend-paying stocks, and commodities, scooping them up at 30 to 40 cents on the dollar from desperate sellers.
And we have to talk about the crypto question here because Dempsey has a very specific and highly controversial take on Bitcoin and Ethereum.
Oh, this is fascinating.
He notes that right now, crypto is highly correlated with the traditional stock market because all this institutional risk money has flooded into the space.
Right.
He predicts that when the crash hits and the margin calls go out, crypto will absolutely plummet, crashing 70 to 90% as institutions liquidate everything to raise cash.
People will declare it dead for the 100th time.
But Dempsey says that is the exact moment you buy it hand over fist, anticipating a massive second surge as people lose faith in fiat currency and seek decentralized alternatives.
If we connect this to the bigger picture, we really need to provide some critical pushback on this overall strategy based on the logic within Dempsey's own text.
Yeah, we have to.
His plan is bold, but it contains a massive, potentially fatal contradiction.
I noticed this too. Let's unpack the cash paradox.
Okay, so Dempsey is warning us repeatedly about rampant double-digit inflation destroying the purchasing power of the fiat dollar. We talk about 15% real inflation.
Right.
Yet his primary survival mechanism is to hold 60 to 80% of your wealth in fiat cash right before the crash.
It's a huge risk.
If inflation surges dramatically before asset prices drop, or if you mistime the market by even 2 or 3 years, that massive cash position will be decimated by inflation before you ever get the chance to buy the dip.
Dempsey admits timing the market is a risk, but holding cash in hyperinflation is a monumental gamble.
It's like trying to catch a falling knife while standing in a blazing fire. You might catch the knife, but you'll burn to death doing it. The cost of being early is exactly the same as being wrong.
That's a great way to put it.
And what about the crypto advice?
That is also philosophically highly contradictory. Dempsey preaches the virtues of physical, tangible assets, gold, silver, land, commodities, because he deeply distrusts digital fiat illusions on bank ledgers. Yet, he advises buying heavily into highly volatile, purely digital assets like crypto after a crash. Is trusting a decentralized digital token, which requires massive internet infrastructure and power grids to operate, consistent with the worldview of a man who demands the physical security of a gold coin in his hand.
It really doesn't seem to fit.
It seems mathematically and philosophically at odds with his core thesis of returning to tangible reality.
Here's where it gets really interesting, though. Because as we strive for that metamodern synthesis, I don't think the true value of Dempsey's work is in blindly following his specific ETS pickers or his exact cash allocation percentages.
No, definitely not.
If you just copy his portfolio, you're missing the point.
It's about adopting the broader framework.
Exactly. The true metamodern synthesis is the psychological posture he is demanding of us.
Yes.
Postmodernism relies on the comforting illusion that the experts have it all figured out, that the central banks can print prosperity, that the FDIC will magically save everyone, and that lines on a graph will go up forever without consequences.
It's a fantasy.
Metamodernism demands that we acknowledge the rot in the foundation. It demands that we prepare for reality, that we anchor ourselves to tangible, real-world assets, reduce our personal debt, and develop actual skills, rather than playing the ostrich and burying our heads in the sand while the commercial real estate market implodes above us.
That is the synthesis. We are inevitably transitioning from an era of financialized abstraction where wealth was made by shuffling digital paper back to an era of tangible reality. The illusion is ending.
Let's briefly recap this incredible journey we've been on. We started by diagnosing the artificial fiat economy, diving deep into the mechanics of why physical money is dwarfed by an $83 trillion digital ledger.
We dissected the commercial real estate time bomb,
examining how 5 to 7 year interest-only ARMs and remote work created $2 trillion in underwater loans that threatened to trigger a massive regional banking crisis.
We saw how that contagion could pop the Fed-engineered stock and bond bubbles,
and trigger a catastrophic global margin call in the yen carry trade. We uncovered the systemic rot facing the consumer, from the $1.77 trillion student loan trap to the shocking reality that the FDIC only covers a fraction of a percent of deposits, leaving you legally vulnerable to Dodd-Frank bank bail-ins.
And finally, we explored Dempsey's radical, if slightly contradictory, strategy to step out of the illusion, preserve capital, and thrive in the ruins.
And as we close, I want to offer some grounding philosophical advice to you, the listener. We have covered a massive amount of terrifying macroeconomic data today. It is easy to feel overwhelmed or paralyzed.
But in an era of information overload, algorithmic manipulation, and impending financial panic, your greatest asset isn't a silver coin, a whole life insurance policy, or an inverse ETF.
No.
Your greatest asset is your critical thinking. It is your adaptability. It is your absolute unwillingness to blindly follow the herd over the cliff. Education, awareness, and emotional resilience are the true safe havens in any crisis.
I couldn't agree more. Don't panic, but prepare. And I want to leave you with one final provocative thought to mull over as you go about your day. Let's return to the concept of the fiat illusion we discussed at the very beginning.
Right.
If the entire global economy, the stock market, the banking system, the purchasing power of your paycheck is essentially propped up by our collective shared belief in this hallucination,
what happens when the hallucination ends?
what happens to the very concept of value itself when a crash shatters that belief? If money as we know it is just a shared illusion that evaporates when confidence fails, perhaps true wealth in the coming metamodern era won't be defined by the digital balance in your brokerage account.
It will be defined by something real.
Perhaps true wealth will be defined by self-reliance, the strength and mutual aid of your local community, and the tangible, irreplaceable skills you actually bring to the table when the digital screens finally go dark. Thank you for diving deep with us today. Stay sharp, keep questioning the narrative, and we'll see you next time.
Well, that was today's episode of Metamodernism Uncensored. Thank you for joining, and we'll see you again next time.